So, Will, maybe we'll start with you. If you would just describe blockchain technology and then maybe how it compares to other technology that's being used by financial statement preparers.
Sure. So at its fundamental core, blockchain is really a database or a ledger. And so it's very similar to what financial preparers use today to capture transactions. The major difference is that the database is maintained by a peer-to-peer network. So there's redundant copies of the information being stored across that network. And because of the way the consensus protocols work within the network, it's tamper-proof. So a lot of the reconciliation you have to do with traditional databases goes away once you implement a blockchain.
Right. Okay. Jake, any thoughts on that? Similarities or differences to what people are using today?
I would compare it as kind of a new database technology as well. Blockchain is not an application. It's not an end-to-end solution in and of itself, but it's a new type of database technology. Whereas previous databases technology have focused on scalability, how much data can you store, how much data can you move and transfer. What's new and unique about blockchain, it specifically focuses on kind of two new aspects, which is trustworthiness and the governance of data which happens on a network. Don't think of blockchain technology as a new application that you're going to install in your enterprise and it's going to give you new reporting capabilities, but it's a new foundational technology that'll end up affecting financial reporting in very big ways, I think.
Okay, interesting. So, Jake, do you see blockchain being implemented incrementally in financial reporting, or does it really require a complete commitment in the industry?
Absolutely incrementally. You're not going to see a tsunami wave where everybody's all of a sudden on the blockchain, not by any means. I think what you'll see is either individual business units starting to adopt it or individual business processes start to utilize the technology. Those use cases have to prove themselves out first in their own little miniature ecosystems before you see the proliferation of the technology to multi-network banking infrastructure. So it'll start small, prove itself, and then work its up to very large networks. That's what I see.
Okay. Well, you agree?
Yeah, I absolutely agree. So most of the use cases that we see right now are specific applications for business processes. So things like trading consortium or supply chain management, very detailed processes, not ERP replacements. So it's very, very focused and specific.
Got it. Okay. So what are some specific examples on the balance sheet or income statement where blockchain could really make a difference?
What I would say is don't focus on specific line items per se, but every single line item. What I think will ultimately be realized is that the accuracy and the validity of what's represented on those statements is going to be more inherently trustworthy. It's going to be more accurate, and maybe you'll get those at a more frequent pace. So I think across financial reporting, nothing specifically in terms of line items, but you'll just have increased transparency, increased frequency of data delivery. So I think they'll just generally be more real time and not specific line items per se.
Okay. Will?
I completely agree that it could have an impact on every single line item because it is a record-keeping technology. At the same time, I think, though, that it's primarily going to start with places where there's transactions being captured, so product sales, cost of goods sold, et cetera, and less where there's estimates. So places where there's really complex estimates like pension liabilities, workers' comp liabilities, those kinds of things. Haven't really seen a lot of blockchain solutions there because those require estimate processes in the financial reporting cycle.
So what are the more significant roadblocks to implementation?
Sure. So a couple of things that come up during blockchain implementations. The first, there's always concern about privacy because you are propagating data across a large network. And so you have to trust the encryption routines that are being used in the blockchain to protect your privacy. But even that can get a little bit scary for some companies. At the same time, because you are propagating data across an entire network, there's data volume and velocity concerns potentially. So taking an entire enterprise's worth of information and then multiplying it 5, 6, 7, 8, 9 times, it's a lot of data cost. So you have to find a way to scale the data appropriately so that you can manage that flow of information across the network.
Any thoughts, Jake?
Integration is going to be a big one. Blockchain is not your traditional relational database, so your traditional middleware isn't just going to connect a blockchain to your ERP. So, imagine a simple task of creating journal entries based on events that happen on a blockchain. You're going to require new software to do that. So integration, I think, is probably the biggest hurdle to adoption.
Okay. So, Jake, this question is more for you. Cost is always obviously a big concern. So, how would you describe the capital commitment needed by organizations to adopt blockchain?
So it's difficult, obviously, because it's an emerging technology. You say, all right, what's the average cost of a blockchain implementation? Well, there really is no such thing right now. The way I would approach this question is to think about your organization, what's your risk culture, and in evaluating a potential blockchain implementation, how much could it potentially impact the core business? And if the potential is high, it might be time to start investing in the technology. You probably start the way everybody else does and run a proof of concept. Those can range from, you find a startup that'll, be willing to offer its technology for free to prove itself out. And some companies are, charging millions of dollars for a proof of concept. So there's not a specific answer other than, look at your business and figure out, based on your risk culture, when is it time to start investing in this technology. It's certainly really early in the adoption curve, so you're not necessarily going to miss the boat, but if your company is one that wants to be an early adopter and a first mover in the marketplace with a blockchain-based product, then now is probably time to start thinking about an investment.
So, Will, what about the internal control aspect?
Sure. So if companies are going to bring in blockchain technology to the financial reporting process, either maybe it's a proof of concept, maybe it's an implementation in production, they need to have the internal controls over that information, just like they do every other system that's used in financial reporting. With a blockchain, that could take a lot of different forms. Maybe it's general IT controls, maybe it's information controls that are being managed by another organization. Maybe there are things that are inherent in the blockchain themselves that need to be evaluated. So it's a little bit of a different skill set and a different approach towards internal controls, but still something that companies need to consider.